Hello again. It's your neighborhood financial economist, Katie Mark. Thank you for joining me once again for another installment of IJS Speaks. So it's Friday the 13th, by the way. So, hey, if you're superstitious, hey. If you're not, hey. But it's Friday the 13th. It's the end of the trading week, and it's towards the end of the week. Typically, I try to reduce risk and raise liquidity. This week, no different. One of the last things I had on my books, on my trading book for the week, were these put options on GLD, and I was looking to see gold continue with a leg down from what we saw earlier in the week in Sunday into Monday with the Biden announcement, but it didn't. The market's pretty much traded flat in terms of the dollar, gold, and equities. We only really saw a little bit of movement, a little bit of parabolic movement in the 10-year and crude oil. The movement pretty much brought the 10-year back in line with the dollar. Crude oil is still roughly out there doing its thing. Even though it does look like it's taking up a bit of an inverse relationship with the 10-year. So it'll be interesting to see how that plays out going forward. Might have something to do with inflation expectations, or maybe even the carrying cost of producing oil. But I'll look into it, and we'll see how the markets play out in the coming days and weeks. See if the relationship holds up, and then I'll see if there's a narrative that forms around that. And we'll look for some kind of fundamental reason why the relationship should continue, and also can function as a marker as to when the relationship is breaking down. So back to the trade book. Had 2 puts on gold. They were fairly cheap coming in, so max loss on them $100. Not that serious. I was also looking to continue that risk off sentiment overnight. I didn't want to take on too much risk, so I looked at the Aussie US dollar. Looked like it was setting up for a short Aussie long dollar. The candle patterns were at least didn't play out, got stopped out, not a problem. It's Friday morning. I put a fairly close trailing stop loss on there. I think I was only looking to get stopped out at like a 0.25% move or something. Just basically something that is there to take advantage of a sudden spike in volatility, so the price is running in my direction. But anything less, the trade gets stopped out. So yeah, gold. So looking at gold, I'm looking at the dollar, looking at the 10-year. It seemed to me that the dollar was losing momentum, and I got confirmation in the 10-year. The US 10-year also started losing momentum, and that raised my alarm, I guess, raised an eyebrow to my gold position, because the dollar and the 10-year were all of a sudden pointing in a risk on sentiment, and my gold position was still pointing risk off. So to offset it, I basically just put on 2 calls. Again, fairly cheap because market's been moving sideways for the most part. And they expire today, so very little time value on them, so also very cheap. But the puts also expire today, so the goal is just to find some kind of an offset. Now, initially, I was looking at selling a spread, like a straddle or a strangle, in anticipation of, no volatility. But on Fridays, market's thin, trading's light, volume's light. It's easy to get a spike with very little volume, very little fundamental reasoning behind it, just, on thin trading. So, decided against that and instead opted for a synthetic strangle. So, with the existing puts, I just bought a couple calls. They were at the money, but still fairly cheap. And now they're basically providing a little bit of an offset to those puts that I'm expecting to expire worthless at the end of trading today. So yeah, that's it for the trading book. The Aussie this morning, that was a swing and a miss. And gold, I'm trying to bring it on home. If the dollar keeps expressing weakness, then I can see a little bit of lift on gold prices towards the end of the trading session. That would be awesome. But for the most part, we're looking to just coast on into the weekend. Looking at medium-term chart of the S&P or E-mini S&P futures, I opted to increase my equity exposure going into the weekend. The rationale behind that is with the spikes and the increases in COVID infections, governments and fiscal authorities are going to be forced to chip in, to lend a hand to consumers, which is ultimately good for consumption, good for households, and in some cases, when there is income substitution, it also supports local businesses, local economies, and it keeps the financial system stable. Most importantly, the financial system remains stable because households have liquidity. So the idea behind that is going into lockdowns, you basically are at the worst of it. So it's only up from here. So at this point, I chose to increase my equity exposure a little bit. The markets have been looking for any possible reason to trend higher. So I'm looking to take advantage of that momentum. The fundamentals tell a different story, and that's why I'm not necessarily just loading the boat with equities right now, but I'm slowly increasing my exposure. That's about it for the trade book. But other than that, interestingly, I like to look at I have a simple equity portfolio. My personal take on equities, I don't necessarily trade them actively. I look at the equity side of the portfolio as providing an anchor to the portfolio. My concept that I use to my concept and my thought process around equities are they are buy and hold instruments. For trading, I rather utilize leveraged instruments like options, futures, spot forex. Risk management, of course, is important. Money management, of course, is important. But I also look at equity indices as a bit of a pulse for the comparative value that global investors place on different regions. And for me, I try to keep it as simple as possible. So I look at an ETF that focuses on Africa as a whole. I've got one that looks at the Eurozone. I've got one that looks at the United Kingdom separately. Then I look at Latin America. And I look at Asia Pacific. I used to follow the Gulf, but it trends so closely with oil prices that it really, for the same exposure, I could just trade crude oil futures or gasoline futures. So I decided not to commit the capital to it. But what I've been surprised about is the return on the Africa ETF. That one stands out to me because the current global economic environment seems like it would lend more towards capital flows out of emerging markets and into developed markets for safety and liquidity. But the growth in Africa is still baked into their equity markets. Latin America has been very good as well. The Eurozone has outperformed, and the United Kingdom has lagged. I think that's tied into the Brexit issue that's being sorted out. So we'll see how that plays out, but from a market perspective, market participants seem to be leaning towards more value staying with the European Union versus with the United Kingdom at the end of all this. So at least that's my interpretation of what I'm seeing in the equities market. And then Latin America has been very good. It's been growing. Pacific Asia has been growing. And that lends to the stability in the region that China provides versus the stability that the United States used to provide in this region, or the stability that countries like the United Kingdom, France, Germany used to provide in their region. I'm interested to see how this plays out as we wrap up the year, because it's the end of the year. I like to tell people at this point that we're almost in 2021. It's time to start thinking about 2021. And it's time to start thinking about how we're going to go forward with investing. How are we going to go forward with trading in particular? Because investing, in all honesty, true investing is a long game. And in the long game, you really are looking to find value and hold on to it. And it works beautifully, especially when markets are trending. Like we saw from 2010-ish to about 2000 and let's call it 19-ish. Markets are trending higher. It's a beautiful thing because you can just buy and hold almost anything and it will appreciate. But I think going into next year, the expectation, at least as of this point, and this is pre-Thanksgiving, is equity markets to underperform. Now, underperform in terms of passive returns. But I think due to COVID and the geopolitics that are going to arise around vaccine distribution, I think that's definitely going to create volatility. So from a trading standpoint, I expect trading opportunities to be abound. But from an investing standpoint, I do expect the garden variety investor will have to commit more time, energy, and resources in finding and vetting the value plays that they can hold in their portfolio. Now, believe me, there will be value to be found because a lot of business models are going to be tested, and depending on the financial soundness of the company, regardless of the viability of the business model, they may not be able to maintain their current managerial or ownership structure. So there are going to be bankruptcies, there are going to be foreclosures, and there are going to be opportunities for the liquid investor to step in and acquire assets. But there's also going to be opportunity for investors that do not do their due diligence to end up buying and owning stuff that they can't sell, even if they wanted to. And that's also important. Knowing what to buy and what not to buy in most cases. Up to this point, 2020 has been the year of coronavirus. And it seems like we'll bring everything to a head with Donald Trump, right? Trying to figure out whether or how or when or if this guy will accept the fact that, yes, as a Republican, more people voted for him than any other Republican ever in American history. But as a candidate in a popularity contest, and that's all this really was, is a popularity contest, the other guy was a couple million votes more popular. And that probably is the thing that irks our current president the most. But I mean, hey, sometimes it takes a politician to win at politics. Sometimes. But back to more important issues. Looking at, we'll start east and work our way west. Looking at Asia. Asia is managing very well with the coronavirus. And so they're able to build a little bit more footing under their economy, a little bit more stability under their economy. In the region, the Middle East is still unstable, still unstable geopolitically. That's it. That's their narrative. There's geopolitical instability. That's their narrative. Europe, they're having a hard time right now. They really are. And Europe is contending with deflation. I mean, how else can you explain government bond yields being negative out 10 years? Market participants are expecting negative growth. Falling prices. That's the expectation. Falling prices. Falling asset prices. Stagnating wages. That's what market participants are expecting for Europe. They've dealt with disinflation for the last decade. The European Central Bank has not been able to generate inflation. No central bank has been able to generate inflation. But the European Central Bank has been trying to do it in an environment, in a disinflationary environment, just like the Bank of Japan have been trying to do it in a deflationary environment. And they've also failed at it. Well, I think now Europe is transitioning from disinflation to deflation. And just like the coronavirus, the specter of deflation moves westward. And the United States is next. The Federal Reserve has not been able to generate inflation in a disinflationary period. And the United States continues to be in a disinflationary period, which is fine. It's all fine and good. But with the immigration stance that the United States is taking, it's gonna go the way of countries like Japan and Germany. Simply because you need immigrants to move into your country and increase your population, and also to have more babies, which further increases your population. You have to keep in mind demographics change over time, and as economies mature and the workforces mature, you typically find falling birth rates. So you have less babies replenishing your population, and the current population living longer due to better medical care. You end up with an aging population. Immigration is a way of replenishing your population. And people tend to immigrate when they're younger, while they're still having babies. And babies create demand without adding to supply. Babies need stuff every day. And the parents, it's up to the parents to have to work more, produce more, to be able to provide for the baby. And the baby adds nothing to supply. So babies are inherently good for inflation. They create demand without adding to the supply. But that's just my take on that. So I sit back, I'm looking at the dashboard. I've already cleaned it up, taken off my Fibonacci's. I'm just looking at support resistance levels. Just watching gold as it makes its way to the close. And I'm looking at my offset. the thing keeps fluctuating back and forth between between profitability and loss. So now, as options traders may be aware of, with spreads like straddles and strangles, the goal or the objective is for the price to get beyond your strike price plus or minus your costs. And if the price happens to settle right in between your strikes, you have nothing but spent premiums. So, in an attempt to offset what would have been an otherwise smaller loss, I have to admit I have increased my exposure. But as a trader, as a market participant, I like to be in active control. And this is a way to be in active control. I can actively manage the exposure. I can actively manage a risk. And I can buy and sell around a position that's been anchored in the trade book, and manage my way to the close. I think that's all in the day's trading. So that's my take for this week ending Friday the 13th, November 2020. Keep an eye on gold. Until next time, take profits when you can. Seek out value, buy and hold when you have to. Make money. If you have any questions, you can always email me at contact@runthenumbers.biz. Contact@runthenumbers, RUNTHENUMBERS.biz. And I will try to answer the questions or have a solution to your problem by the next episode or the next installment. Until then, good trading. Keep making money.